This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Friday, November the 8th, 2013. I'm Gord Long at GordonTLong.com. As usual, I have a lot of charts for us to go through this morning, so therefore I'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your slide viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing here this morning. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term confidence and sentiment. In this regard, I would like to distill this month's audio down to a discussion on flows, specifically how perceptions on flows have now got control of the market. We need and must understand where the risks are. To understand risks and flows better, we will examine liquidity, credit, and debt. Our studies section this month is particularly large, so some of the subjects I normally talk about in this audio I'll leave you to read in the studies section of this month's MATA written report. In the new world, dominated by fiat currencies and debt, liquidity is credit, and credit is debt. Credit and debt are used interchangeably as simply the opposite sides of the same coin. But there are important differences and distinctions that are critical. Liquidity is the degree of ease with which an asset or security can be bought or sold in the market without affecting the asset's price. Liquidity is characterized by a high level of trading activity. Assets that can be easily bought or sold are known as liquid assets. This ability to convert an asset to cash quickly can also be thought as marketability. Credit. The term refers to the borrowing capacity of an individual or company. This is a contractual agreement. The amount of money available to be borrowed by an individual or a company is referred to as credit because it must be paid back to the lender at some point in the future. For example, when you make a purchase at your local mall with your Visa card, it is considered a form of credit because you are buying goods with the understanding that you will need to pay for them later. Debt, on the other hand, is the amount. Debt is the amount of money borrowed by one party from another. So, liquidity, the degree or ease with which assets or securities can be bought or sold, is about policy. It is about monetary, fiscal, and public policy set by authorities in control of these policies. These policies no longer have the policing restrictions they once did before governments unilaterally, without a plebiscite of the electorate, moved to fiat currencies, which are backed by nothing other than the credit and good faith of the government, or more specifically, the taxpayer. Credit as the borrowing capacity of an individual or company has historically been determined by banking regulations based on lending requirements such as capital ratios, reserve ratios, capital classifications, and other enforced controls. Today, however, we have a approximately $72 trillion global shadow banking system operating that is basically unregulated and opaque, which uses esoteric structures such as SIVs, that stands for Structured Investment Vehicles, securitization instruments such as MBSs or ABSs, ABS stands for Asset-Backed Securities, offshore and other off-balance sheet instruments employing terminologies such as contingent liabilities, repos, rehypothecation, collateral transformations, etc., etc. Terminology I'm sure very few of you have heard. You will in a not too distant future as we face the next crisis. As banks create money out of thin air by means of their fractional reserve banking system, credit is likewise conjured up with even greater ease now today. Debt, as the amount of money actually borrowed by one party from another, is determined by the economic capabilities of supporting the debt borrowed. We are talking total debt, which includes public, private, and household debt. It also includes off-balance sheet and contingent liability debt, though this is never reported or visible. This is because the economy must support this debt and the liabilities which come with it existing, whether it's reported or not. It's still, if you would, sucking the wealth out of the economy. Our debt-based economic system has become fueled by credit and the liquidity that allows the degree and ease by which it flows. What few appreciate and must be understood is that it must be extremely tightly controlled or you will get mispricing, misallocation of capital, and malinvestment. You also get moral hazard and unintended consequences. After nearly 9 years of extremely low interest rates and 5 years of nearly zero interest rates, by now we should expect no less than these elements being a major concern. They are, but no one wants to talk about them because Keynesian economics has no answers to this, and no one knows what else to do. That doesn't mean it doesn't exist, however, with all the consequences as I've outlined extensively in the monetary malpractice and moral malady sessions that we've had previously. But let me not digress here today. The players and dynamics at play we are familiar with, but are worth restating. Central banks. The central banks, which in the case of the Federal Reserve in the United States, are not government apparatuses. The Fed is a quasi-government structure that is actually owned by the banks. Ben Bernanke's legal boss are the shareholders, which are the banks. He may be appointed by the president, which he is, approved by the Congress, and give testimony before Senate and Housing Banking Committees, but his job is about the soundness and the protection of the banks. The economy matters only in how it impacts lending and risk. The Fed's dual mandate of price stability and full employment are really a measure of how risky bank loans are and whether the debt obligations can be carried by the economy, the debt obligations to the bank. That's what they're worrying about, not you, the taxpayer. As big a subject as this is, I want to focus, however, this morning on credit, which is about the commercial banks, and debt, which is about the debtors. I want to differentiate clearly here about the differences between, at the bank level, about 1, the ability to lend, and 2, the ability to borrow, versus 3, the desire to lend, and 3, the desire to borrow. And I'm differentiating ability and desire because they're critically important that you differentiate these in your mind. Each of these has different controllers, metrics, and ways of assessing. Obviously, they all work together, but changes in any one of these and this liquidity, credit, debit flow can suddenly and will stop or slow precipitously. The banks, as we are all quite aware, are in the business of trafficking in debt. We have become so addicted to debt that we might want to think of banks as pushers. The private, public, and household sectors have become addicts, completely incapable of stopping. Never has that age-old adage been truer. Gold is the currency of kings, silver the currency of merchants, and debt the currency of the poor. The motivations need to be considered also carefully. The pricing of the drug is like pricing heroin. The stronger the desire and need for the drug, the higher will be the price and the profits. This will continue until the inevitable happens when the addict simply is unable to pay and must resort to unsavory means to support that addiction. What does this mean to credit and debt? Let's look more closely. The ability to create credit is about the capacity. The capacity is about 1, margin or leverage, and 2, collateral. The desire to create debt is about the levels which are driven by 1, sentiment or confidence, and 2, greed and fear or speculation. What is critical to appreciate is the transformation of liquidity to credit to debt. The transformation of credit to debt is breaking down in a couple of very key areas. First, the desire to lend by the banks is decidedly muted, as demonstrated by the fact that they have over $2 trillion of excess reserves at the Federal Reserve. They simply can't find the loans that have satisfactory lending profiles. Additionally, corporations are not investing in capex and are using their cash flows to fund investment or cheap commercial paper. They're not making investments. Both of these beg questions. Secondly, those trading or wildly speculating in paper assets, and I want to stress the word paper investments, can't find sufficient low-risk collateral, so that they are now resorting to strategies such as collateral transformation with the banks to make this happen. Credit is flowing only to the financial intermediaries that are trading in paper claims on wealth, not to the economy that actually creates the wealth. And it isn't the banks that don't want to lend, as I said. The growth and opportunities simply are not seen to be there. Simply put, there is too much mispricing, excess malinvestment, and distorted allocation of capital for anybody that truly knows what they're doing and what they're investing in. And it is showing up with the collateral shortage. And this is what we need to understand more. Credit may be money, but money is not capital. Credit and currencies are IOUs. Credit and currency are only claims on wealth. These claims must be enforced by law and hopefully honored. They are not wealth in your hand. They are no longer a store of value when currencies can be arbitrarily debased to avoid paying existing claim values. Capital, on the other hand, is unencumbered wealth. Capital is created, not printed. Capital is created from savings from profits. Capital can be thought of as only being created by either growing it, building it, or making it. You can never print it. And it's important that you fundamentally understand that differentiation and where the store of value is. Where is the problem? As I've mentioned, it's about collateral. We have impaired collateral underpinning the debt right now. We have exploding non-performing loans around the world, most noticeably in the housing sector. And housing loans, but it's broad-based, and in some cases 12 and 13, 14%. We have rampant malinvestment and mispricing from an excessively protracted period of easy credit. We have leverage and margin at unprecedented historic levels. We have rehypothecation, which is the unregulated debt usage as collateral to secure debt, with no restrictions. $700 trillion of unregulated swaps market, which uses dubious and opaque collateral requirements. A $72 trillion unregulated shadow banking system with also dubious collateral. Central banks accepting sub-quality collateral for risk-free collateral. I mean, nothing can be more blatant than how bad it's getting in Europe, where even small business loans are now being used as collateral at the ECB. The process of collateral transformation itself, which I've mentioned, which is again unregulated and growing at a significant rate. This is risk compounding at a significant rate. Credit always leads the way in the market, and we're seeing more and more discontinuities of lack of faith in credit, even though stocks are up and have been kind of leveling off here. And they will, I expect after a correction, for them to continue to lift. But credit is going to continue to diverge as we move ourselves into something that I refer to as the crack-up boom. We have more to go in what is appearing more and more to be stages of a von Mises crack-up boom. We'll talk a lot more about this in other reports. In closing, I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2013 turn out to be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.